Hey everyone, welcome back to Corporate Dakota, where today we're diving deep into Essex Property Trust's latest annual report. And let me tell you, they have a lot of properties to talk about. Prepare yourselves because this filing is a real estate deep dive. Before we jump in, if you love getting the real story behind these corporate filings, make sure you hit that subscribe button and ring the bell. And hey, we've got a fantastic community over on Discord, linked in the description below, where we break down these reports even further. Alright, so Essex Property Trust, like many big companies, has to file this annual report, a Form 10K, with the sexy think of it as their yearly checkup, where they lay out everything that happened over the past year. And lucky for us, they've combined the reports for Essex Property Trust, Incorporated, and their main operating company, Essex Portfolio. LP, they're basically saying, we're one team. Let's talk about ourselves as one. So who are these guys? Essex is a big real estate investment trust, a REIT, that focuses on apartment communities. And when I say big, I mean they operate all over the west coast of the United States, mainly in Southern California, Northern California, and the Seattle metro area. As of the end of 2025, they owned or had stakes in 259 apartment communities, which adds up to over 63,000 apartment homes. Imagine keeping track of all that. It is quite the operation. Let's talk about what they've been buying. In 2025, they made some significant acquisitions. They picked up properties like the Plaza for about $161 million, Rowan Menlo Park for nearly $79 million, and Vio for a cool $100 million. These are just a few examples, but it shows they're actively expanding their portfolio, spending close to $830 million on new properties. But it is not all about buying. They also sold off some properties they felt no longer fit their strategy. They sold Highridge for $127 million, Essex Skyline for almost $240 million, and the Grand for about $97.5 million. This selling off process combined with their buying is a way they try to keep their portfolio focused on the best, most profitable locations. Now, beyond just owning apartments, Essex is also building new ones. They have one big consolidated development project with 543 apartment homes in the works, plus other pre-development projects. They're planning to spend around $200 million more on these projects, with the total estimated cost reaching over $358 million. This shows they are investing in the future. When you are managing properties like this, you need a lot of money. Essex has billions in debt, but they're also managing it smartly. In 2025, they issued new senior unsecured notes worth $400 million and another $350 million. They're using this money to pay off older debts and fund new projects, which is pretty standard for a company this size. It is also worth noting their credit ratings. Both Moody's and S&P give them pretty good grades, BARB1 and BB respectively, which means they're considered stable and a good bet for lenders. This helps them borrow money at better rates. Now, if you own shares of Essex, you are probably wondering how they're doing. Their stock trades on the New York Stock Exchange under the symbol ASS as of the 30th of June 2025. The value of stock held by people outside the company was about $18.1 billion. Let's look at how their stock has performed. Since the end of 2020, Essex's stock has grown significantly, outpacing the FTSE Nareit Equity Apartments Index, though not quite matching the S&P 500. From $100 in 2020, their stock value reached about $130 by the end of 2025, while the S&P 500 more than doubled to nearly $196. This shows that while Essex is growing, the broader stock market has been a stronger performer for investors in recent years. Now, let's get into the nitty-gritty of their operations. The company's main income comes from renting out apartments, which is great, but they also have revenues from management fees and other property-related income. Looking at their revenues, rental income alone was over $1.8 billion in 2025, an increase from the previous year. That is a massive amount of rent money coming in. What is really interesting is their same property revenues. This means they're looking at properties they owned in both 2024 and 2025 to see how they performed. This revenue increased by 3.3%. They attribute this primarily to a 2.3% increase in average rental rates, meaning they're able to charge more for rent, and a slight decrease in delinquencies, meaning more people are paying on time. But here is the catch. Expenses are going up too. Their operating expenses, not counting property taxes, went up by 5.5%. This is due to higher costs for utilities, more money spent on personnel due to wage inflation, and increased maintenance costs, like fixing water damage. It is a constant battle to keep costs down while revenues go up. They also made a lot of money selling properties. The gains from selling real estate jumped significantly in 2025, bringing in nearly $300 million. This is a big boost to their bottom line, showing they managed to sell properties for a good profit. On the flip side, their interest expense also went up. This is mainly because they took on more debt to finance new deals and pay off existing ones. It cost them an extra $23 million just in interest payments. It is a delicate balancing act between borrowing to grow and managing the cost of that debt. So what does all this mean for their profit? Net income available to common stockholders was around $670 million in 2025. While this is lower than the $741 million in 2024, it is still a very strong profit. They're clearly a profitable company even with rising costs and debt. Let's look at net operating income, or NII, which shows how their properties themselves are performing before financing and corporate costs. Their NII increased to over $1.3 billion, which is a good sign. It means their core real estate business is generating more cash. Now, no company is without risks, and Essex lays them all out. They're worried about general economic downturns, which could lead to fewer people renting or paying less. Rent control laws are a big concern as they can limit how much rent they can charge. Development projects can get delayed or go over budget. And concentrating their business on the West Coast makes them vulnerable to local economic problems, like natural disasters or industry-specific downturns. They also rely heavily on technology and software, and any major security breach or failure with these providers could cause serious problems. This is becoming a bigger risk for all companies, with the rise of AI potentially creating new vulnerabilities. And of course, they depend on their people. Losing key executives or having trouble hiring good people, especially at their apartment communities, could really hurt their operations and customer service. Interestingly, they're also concerned about what certain advisory firms think of their corporate governance. If these firms give them a low score, it could negatively impact how investors see the company and ultimately their stock price. It is a reminder that public perception and corporate reputation matter a lot. Looking at their balance sheet, their real estate investments alone are worth over $11.9 billion. That is a huge asset base. Their total assets are over $13 billion. On the other side of the coin, their total liabilities are around $7.4 billion. This means they have a solid amount of equity backing up their assets, which is a good sign of financial health. Their total stockholders' equity stands at over $5.7 billion. This equity is made up of common stock, additional paid-in capital, and other components. It shows the net worth of the company that belongs to the shareholders. Let's check their cash flow. In 2025, they generated over $1 billion from their operating activities. That is the cash generated from their day-to-day business of renting apartments. However, they used a significant amount of cash, over $550 million, for investing activities, mainly buying and developing properties. They also used over $500 million for financing activities, like paying back debt and issuing new shares. Diving into the notes, we see they have a lot of detail about their accounting policies. They're following us generally accepted accounting principles, or GAAP, which is the standard way to prepare financial statements. They use fair value to assess their assets and liabilities, which means they're trying to reflect what things are worth in the current market. And finally, this massive schedule the third, lists out all their individual properties, their costs, and how much depreciation they've taken. It's a detailed look at every single building they own, highlighting the sheer scale of their real estate empire. So, what is the takeaway here? Essex Property Trust is a massive player in the West Coast apartment market. They're actively acquiring and developing properties, and their core business of renting apartments is strong, with rental rates increasing. However, they're dealing with rising operating costs and a lot of debt, which is standard for a company in this sector. Their stock has grown, but not as fast as the overall market recently. They face significant risks related to the economy, regulations, and their technology dependence, but overall they appear to be a stable and profitable company navigating a complex market. What do you think about Essex's strategy and their numbers? Let me know in the comments below. If you found this breakdown useful, please hit that like button and subscribe for more decoded corporate insights. And don't forget to join our Discord community, linked in the description for more in-depth discussions. Thanks for watching, and we'll see you next time.